Hello and welcome to the Deduction, a Tax Foundation podcast. I'm your host, Kyle Houlihan, and today we are back with a very special episode with my co-host, Erica York, Senior Economist and Research Director here at the Tax Foundation, and Garrett Watson, Senior Policy Analyst and Modeling Manager here at TF. How are you guys doing?
Doing good.
Living the dream, Kyle.
Good to have you guys here today. So we're opening up the playbook a little. We're going to dive deeper into some critical issues that are shaping our economy and tax policy and legislation going forward. There's this great blog on our site that's breaking down baselines, which are used by the CBO and JCT. And don't worry, I know that you probably don't know what a baseline is. I didn't really know what one was before we started talking about this either. So we have the right experts on, a great lineup to talk us through these complex issues. And, whether you're a seasoned pro or kind of a novice like me, you're going to come away understanding what's going on. And I think, Erica, you have a little breakdown to help people understand what's going on with baselines and to have them be able to grasp this.
Yeah, so I've got a little analogy to get us into the right frame of mind to think about this. And the thing that I thought of was have you ever been shopping and you check out and the cashier hands you your receipt and they say, you saved $35 by shopping with us today. And the right question to ask there is compared to what? Because I either handed you my cash or I swiped my credit or debit card, and ultimately my bank statement is going to say that actually I spent $75 today. I didn't really save $35. So even though, the receipt that's printed out at the bottom of it, it'll say you saved $35 by shopping here. The number that really matters is how much you spent. And the question that really matters is compared to what? So today we're going to dive into those questions about the budget baseline Congress uses. And that is how we answer the question of what is the cost of a law that Congress enacts? And how do we know that this policy change that they're proposing or that they have passed is going to affect the federal government's budget and debt? It's that question of how much does this cost and how do we know that? What are we comparing to? So hopefully that sets us up for thinking about this baseline question.
Thank you. I think that's really helpful for people to understand this a little bit better. So to dive right into the questions here, I'll toss this to you, Garrett. I think this is a softball for you. What roles do the CBO and JCT play in shaping tax policy?
So the Congressional Budget Office and the Joint Committee of Taxation are two organizations that are nested within Capitol Hill that are in existence to serve Congress and provide them the data and information and scoring, in this case, that are needed for policymakers, congressional members, and their staff make decisions and, most importantly, votes on bills that are going to impact the federal budget and, of course, the broader economy, and in this case, taxpayers, when you think about the tax code. And they've been around for a long while now. The Congressional Budget Office, for example, was first instituted in the mid-1970s, very much in response to pressing needs on the Hill to have an independent source of information within Congress. Before that, of course, a lot of information came from the White House and their Office of Management and Budget and the Treasury Department, which provided their own information. But there was a desire to have a separate set of scorekeepers in town to help Congress in particular. And over the last half century, they have been working together, the CBO on mostly, but not exclusively, the spending side of the budget, and the Joint Committee working in taxes in particular to provide that expertise and to allow for some independent, nonpartisan evaluation of what various proposals may do that sort of separates us and puts us away from some of the political considerations that are, of course, baked into any of these items. And just one last piece of context, there, of course, this is part of a much broader environment in DC where independent private sector folks or nonprofit think tanks like the Tax Foundation also provide independent analysis and scoring. And there's, of course, a lot of back and forth between all these organizations on how to think about various bills and what it'll do to impact the budget and individual taxpayers. And so that's what we'll be diving into in detail today.
I think either one of you could probably answer this, maybe Erica. When he says scoring, he means just how much the bill costs or what exactly does that mean? Did I have that right?
Exactly. Tallying up how much is this going to change revenues? How much is this going to change spending? What impact will it have on the deficit? What impact will it have on interest payments? Because if we increase the deficit and increase our debt, we increase how much interest we pay. So it's just scorekeeping to keep track of all of that.
That makes sense. So could we explain the difference between what we mean, in this blog, the current law baseline and the current policy baseline. Could you break that down for us?
So when we talk about baselines, it's really important, as Erica emphasized at the beginning, that we have a relevant compared to what. Because if we don't have a sense of what we're comparing these changes to, it's hard to have a shared understanding of what the trade-offs are of various proposals and what the magnitudes look like over time. So it's important to have what we have as a baseline, some of which is actually counterfactual, right? So when we think about a baseline for tax revenue, or say on the household context, to be your projected future income, you may have to forecast that. And there's always, of course, a lot of uncertainty baked into that, but you want something compared to the actual amount of income or revenue that comes in your forecasts, both compared to the baseline, both in baseline and compared to that baseline for any given proposal. And so that's the big question, is how do you do that? And that is a combination of judgment and expertise. And there's a couple of different ways to do it. Two of which, Kyle, you just mentioned in creating that baseline, are probably the two biggest contrasting approaches that we talk about in DC. One is the current law baseline. What does that mean? That means we're taking a pure current law baseline, takes the law as scheduled, as is set up and scheduled and written by Congress, and takes it at face value as is. Meaning, most specifically, if a law is passed that changes policy, say raises tax rates for 5 years, and then this change expires and the tax rates fall again, it will be evaluated, scored for the revenue collection purposes as having those tax rates increase for 5 years. And then afterward, it's scored as having those 5 years of tax hikes expire. So that's probably one of the more intuitive ways to think about it from a current law baseline perspective. By contrast, you can evaluate the baseline with respect to current policy. What does that mean? The biggest difference between the current policy and current law is the treatment of temporary provision. So in the case of this 5-year tax hike that then expires, current policy looks at that from a baseline perspective and says, hey, we're going to actually evaluate it from the policy as is today. So if today that law is in effect, we're going to assume it continues uninterrupted into the future. And so it would actually be scored as a full 10 years of tax hikes in the baseline moving forward. And so that really matters. I think this is really where it comes into the context of current debates, when you evaluate that with different changes. So if you were to, say, propose cutting that tax hike early, it's going to look very different in a current law baseline versus a current policy baseline. And the other, I think, important point is you can use either one. That's perfectly fine. A point that we emphasize in this piece and as part of the debate is you just want to make sure to use baselines consistently. It's very easy to mix and match baselines to achieve a certain goal for the numbers. But if you use them consistently, that maximizes the value of that information. And that's another really important point. The whole point of creating a baseline and evaluating a proposal with respect to that baseline is to make that information actionable for policymakers, to clarify, not obscure the terms of the debate and the impacts they may have. And so that's the ultimate goal. And there's a lot of course, art and judgment when it comes to that. But that's really where we want to be headed when we think about this broader debate.
Like, just to kind of set the stage a little bit, the baseline that Congress uses is over a 10-year period. So it's looking at the next decade. And that basic baseline says, here's what we think spending is going to look like for the next decade. Here's what we think revenue is going to look like for the next decade. And then if a policymaker proposes a change, the job of JCT or CBO, depending on if it's a tax change or a spending change, is to say, okay, we know this baseline path. Here's how that baseline path is going to change based on your policy. And those two baselines Garrett talked about have implications for what a policy change looks like. Because we can either assume over the next decade, things are going to play out exactly how Congress spelled them to play out. They said, this is going to change for 5 years, so it only changes for 5 years in the baseline. Or we can have a baseline where it says, whatever is in effect today, we're going to assume that continues over the decade. And depending on what that baseline looks like, it can change the costs of a policy change over that decade period that Congress has to look at when they are making spending or revenue changes.
And yeah, I think that that's really helpful to understand this. And I think for any listeners, if you're getting confused, one of them is considering things in a temporary sense, and the other one is considering things in a more permanent sense. That's really the easiest. That's the explain it to me like I'm 5 version. I'm curious because we have a new Congress. We have a lot going on. There's budget stuff happening right now, which is why we're talking about this. I think there are a lot of people that might not understand what is budget reconciliation? What does that mean? And how does it help Congress pass tax changes without needing the same majority votes?
So, budget reconciliation is a parliamentary process or procedure that's done in Congress to reconcile the projected sort of budget, revenue, spending, and deficit targets with the underlying appropriations that Congress goes through. As we know, or as some folks may not be aware, of course, Congress has spelled out in its law a complicated budgeting process that, not to get too in the weeds here, but kicks off with the president introducing a budget in the spring, and then Congress comes back and evaluates that, and then works through committees to appropriate various levels of spending across various committees. That ultimately adds up to the total amount spent, the total amount of revenue collected, and the resulting deficit change, which is the difference between your projected revenue and spending over 10 years. And so, of course, what needs to happen is there needs to be a consistency between what each of these committees is doing in terms of the underlying appropriations and the top line figures that leaders of Congress working with the White House would like to see. And so this reconciliation is basically part of that process. A big part of that, why that tool matters here, is in the Senate, under current Senate rules, if you have a process known as the Senate filibuster, which has been widely known and well known over the last over a century, used quite commonly for the party out of power to slow down or block legislation they do not support. In order to end a Senate filibuster, you need to have 60 votes in the Senate, which means that the party in power would need to have those 60 votes. And so that can slow down or significantly constrain what you might be able to do on a partisan basis in Congress. One key way out of that is through budget reconciliation, where under existing rules, all you need is a simple majority in the Senate, 51 votes or 50 plus the tie-breaking vote of the Vice President of the United States, who is the President of the Senate. And so that allows policymakers of one party in power to get legislation more easily through the Senate, through that might sound like a very arcane niche process to most Americans. But it is important because it does make the difference between legislation being passed and not. It's been used a lot, especially the last couple of decades, increasingly. Most notably, it was used in the 2017 tax law that is expiring at the end of 25 for the individual provisions. It was also used by Democrats most recently to pass, for example, their Inflation Reduction Act of 2022. And so it is a common way for parties to move forward with their preferred policy priorities, though it does come with some constraints. There are some rules known as most commonly the Byrd Rule in the Senate. Just a couple things to note there that are important. One is it does require that certain proposed changes need to have a revenue effect in order for it to qualify for reconciliation. So if you change federal law that doesn't change revenues, it may not qualify. The parliamentarian may say you have to have 60 votes to do this if you want to bypass the filibuster and include it in reconciliation. The second big constraint, among many other smaller ones, is that you cannot increase the budget deficit on net after the budget window past year 10. And that second one is important because it does motivate a lot of folks in both chambers to try to design legislation to not have that outcome. And they do that through a variety of ways, both in terms of policy design and through gimmicks. One that we see quite often is making things temporary. So, for example, passing the individual tax changes of TCJA, having them expire at the end of 2025, that was cheaper than to have them to be passed through 10 full years and made permanent. And that helped them get that legislation over the finish line in reconciliation. And so, yeah, lots of things to think about there. But the big picture thing to know is that this does, it actually influences the content of the legislation at the end of the day. And it does allow parties to move forward on their party line agendas without that filibuster in their way.
Eric, I real quick coming to you with this follow-up. Why does this matter? Why are we talking about baselines right now? And what's the real purpose of this?
Yeah, the reason we're talking about budget reconciliation and baselines is because we have full Republican control of both houses of Congress and the presidency. So that means they will be using budget reconciliation to address a number of their policy priorities, including what to do with the expiring Tax Cuts and Jobs Act. And as Garrett mentioned, one of the trade-offs of budget reconciliation is that it allows you to overcome that filibuster, but it also places a lot of constraints on what you can do. You have to set a limit for how much you can increase the deficit within the 10-year budget window, and then you can't permanently increase the budget deficit. And that's why we're seeing the potential for wanting to change the baseline. So recall Garrett mentioned current law baseline. That takes laws as given. The TCJ was implemented temporarily. It's scheduled to expire under the current law baseline. It expires. Taxes go back up under the current policy baseline based on it this year when the TCJ is still in effect. The current policy baseline would show those tax cuts continuing. And so continuing the tax cuts would look like it's not a tax cut, doesn't have a revenue impact because the baseline assumes that those are going to continue anyway. So that's why we're seeing some lawmakers, some people in the policy community talk about, well, hey, if we use this current policy baseline, then continuing the TCJ isn't going to really cost anything. And that's when we need to get back to that compared to what question. It doesn't cost anything compared to this baseline where we assume it continues. But if we look at the real path of revenues, the real path of deficits, that current policy baseline shows, hey, under tax cuts, revenues are lower, deficits are higher, interest costs are higher, our debt is higher. And so the real flows of revenue are what really matters if we're wanting to, look at fiscal implications or budgetary implications of a policy change.
So, Garrett, you mentioned this. You used this term "mix and match," which I really liked and I thought was helpful. You need to kind of stick with one. You got to marry one of them. You can't date them both. So when Congress is maybe thinking about using that current baseline, what else do you see it affecting for the future government budget and our national debt? What changes?
So, yeah, I think there's a strong argument that in this case, it is a little bit of mixing and matching because the 2017 tax law was passed on a current law baseline, and the arguments were made about its expiration and its future cost on that basis. And now we're switching to a current policy baseline if you were to assume that the tax cuts don't cost anything because you're moving it into the baseline. I think that's a really important point, is that the actual costs and trade-offs and opportunity costs of making this permanent, you can switch where it is, but you don't ultimately get rid of the real cost. The real cost just gets moved from the scored amount into the baseline. So you're just moving all these additional costs into the baseline. The future trajectory of the U.S. debt will still be higher than otherwise would be if those tax cuts are extended. And maybe that's worth the trade-off, right? But it's just important that folks don't confuse the change in the baseline discussion with the actual future path of the debt, interest rates, and everything Erica just mentioned. And so I think that's the really important point, and the point that we emphasized in our piece earlier last week, which was that ultimately we're talking about the real trade-offs of the actual trajectory of our fiscal situation. And so basically by moving to our current policy baseline and arguing, hey, continuing current policy, it should be scored as not changing the budget or revenue relative to that baseline, you effectively built that additional cost into that baseline. And that still is a cost that folks need to think about because it could impact interest rates on their mortgage, right? It could impact how much fiscal space you have moving forward. And of course it does. It also means by on the flip side that if there are offsets we want to use, that actually would be reducing the deficit relative to that baseline. And that maybe still is an opportunity, right? Or if there are spending cuts we want to look at, of course. One thing we did look at quantitatively is specifically if we assume a current policy baseline over the next 10 years, if we want to get on a sustainable fiscal trajectory, one measure of that, as is pushed by the nominee for the Treasury next year, is running a deficit worth about 3% of GDP, meaning 3% of all the U.S. economic output is the value of the deficit the federal government runs every year. Well, to get to that number between current policy and that 3% number, which is fairly sustainable, you would have to find over $2 trillion of cuts between now and 2034. And that 2034 number is going to be about a $2 trillion spread. It's over $1.5 trillion even over the next 5 years. So it's a pretty significant amount, and that's annually. So that's representing a very big fraction of the total U.S. Budget overall. And that just shows sort of the magnitudes here. And none of the baseline gains we're talking about affects that. So I think that's what's one big bottom line here, is we don't want to miss the scoring procedures and the rules and the baseline discussion with the actual trajectory that we're on and what we need to face.
Yeah, exactly. If I can just add to that, like Our baseline deficits now are going to be somewhere around $22 trillion over the next decade under current law baseline. If we extend TCJ, that's going to reduce revenues by like $4 trillion, add like $1 trillion of interest cost. So our total deficit is going to be something like 26, 27 trillion. If instead we switch to a current policy baseline, we're saying it doesn't cost anything to extend the TCJ, but our baseline deficits are 26 or 27 trillion dollars. So it doesn't change that final number. It's just changing the score that's attached to the legislation to get there. One of the analogies we've kind of talked about is like it's like grading on a curve. That doesn't really change how you've done on the paper. That just changes the grade that you're assigned. So if you failed your test, but like everyone else failed it too, and you guys all get bumped up to a C, you really didn't do a good job on the test. Your teacher just like adjusted the score. The underlying information is the same. That's kind of what happens with baseline games like this when you try to change the baseline just to hide the score that gets attached to legislation, but you're not really, changing the underlying path of debt and deficits.
So I think what I come to in all of this is this is about messaging. This is like sort of a political game. This is not we're doing this. There's not like a mathematical reason or some other kind of thing. This is like we're selling a story, right?
I think so much of it is that, and as much as us who work in policy would like, policy and politics are tightly intertwined, and that's always a challenge. And of course, this is also tied into much broader debates about the underlying baseline. There are some criticisms out there on, hey, the existing baseline that CBO uses is arbitrary or could be improved in various ways. It's all very fair. One point or analogy I've also made is that this is much like playing a game of chess in that the rules can be fairly arbitrary. Maybe the rules of chess could be improved even. I don't know. But it's important that we all have agreement on what those rules are and we use them consistently. And if all the actors involved, and it very much is a bipartisan sort of temptation, start changing the rules to benefit themselves when it's their turn in the game is no longer orderly, and it's very hard to tell who the winner and loser is, right? In this case, it's harder to tell what the value of that information is if you're changing the baselines for political reasons. And so that's why it's important, I think, to preserve those rules, make sure they're credible, while also trying to improve upon them moving forward if there are areas where they can be improved. Because they very much still are, right, human constructions, and they're meant to be tools to help us make better decisions in the policy space, but they're not above reproach, and that's definitely not something we want to forward either. But that's different from playing political games to pass something when you're in control.
It's funny when you bring up the chess. What immediately comes to mind is all of the arguments that happen over the holidays right now, where everyone's you come to play. Like my family plays rummy, so we go to play rummy, but all of our cousins play differently, and so everyone's got their house rules, and they're arguing about this, and we're arguing over little things. But everyone wants the house rules because that's how they play and that benefits them. And that kind of applies a little bit here in kind of a silly way. But people are trying to bend the rules to serve them, which is not the best thing for all of us. And especially for lawmakers to really understand exactly what's happening. But yeah, so anyway, that's my little anecdote. Holiday season, we're very competitive with rummy. But to kind of get to wrapping this up here, I wonder, we always like to wrap up with maybe some practical ideas, some things, some suggestions. So maybe we could have some practical ideas that lawmakers, could propose that would encourage economic growth, that would address this crazy deficit, which I believe Erica said 26 trillion, which is a number that is very painful and a lot that I can't even quite understand. So, Garrett, how would you address that?
So there's a few things that could be done here, I think, to move in a constructive direction. One, of course, is looking at this broader situation, these upcoming expirations, as an opportunity to further improve the tax code for taxpayers and to do something meaningfully to address the fiscal trajectory. So one thing we've done at the Tax Foundation is we've done a lot of research over the last year and a half to, one, demonstrate that it is very much possible to prioritize pro-growth and pro-simplicity provisions from the 2017 tax law while also minimizing or eliminating the need to increase the deficit. So providing a series of options that would move the tax code along further in terms of broadening the base and eliminating complicated deductions, credits, expenditures, etc., very much continuing some of the legacy of the 2017 tax law, while also prioritizing extending or making permanent the most pro-growth provisions from the law that we've seen, not just in theory, but also in practice. And that includes, of course, immediate cost recovery to allow companies to fully and immediately expense their investments, making sure we improve the tax treatment of research and development, maintaining that expenditure deduction and the other associated changes there for simplicity for taxpayers. That all can be done while also ensuring that this broader project doesn't meaningfully address or meaningfully increase the budget deficit over the window or in the long run. So that's one sort of major line of thought that we want to continue to encourage policymakers to think about. And the other has been more aspirational and very much might be setting the stage now for future legislation rather than short-term, the possibility of happening in the short run. But trying to think about what if we really overhauled the U.S. tax code to be much simpler, to be much more pro-growth, modeling it after the number one country in our international competitiveness index, Estonia. And so we have a lot of research on that as well, because and one way to think about it is this is also an opportunity to be a stepping stone towards that. It's very unlikely we'll get there all the way this time, but we could think about how do we prioritize provisions that get us closer to that aspiration. And of course, there's a number of threats, including tariffs, that I'm sure Erica could cover on how we try to minimize some of the downside risks too.
Come on, Erica, give us the goods. He was just too optimistic for you.
Yeah, so I'm going to start on an optimistic note and say that Garrett and I, along with Will McBride and Alex Durante on our team, just published a journal article on this exact question: what can we do to address the debt and deficits? And just like Garrett outlined, pro-growth tax reform is an important part of that. Being sure that you don't worsen the incentives in your tax code when you're trying to address debt and deficits. And then also any successful, debt consolidation package that any country has ever adopted addresses spending. So you have to broaden your scope outside of just tax reform and look at fiscal reform, spending and tax reforms that work in tandem to just bring some sanity to the budget. The thing you don't want to do, like I alluded to, is harmful tax increases. Tariffs would be near the top of that list of ways not to reduce the deficit, both because they're just a distortive tax in and of themselves, and because they invite foreign retaliation that further harms the U.S. economy without raising additional revenue for the U.S. Treasury. So you're compounding the harm of your tax increase, which further reduces the revenue and the economic bite that tax takes. So lawmakers will have to be really careful when they are looking for pay-fors to ensure that they're not offsetting the economic benefits of the tax cuts that they're passing.
All right, guys, I feel like this was really helpful for people to understand and a really important topic, something that, like we said, we're diving into the playbook, but I think you guys really helped people explain this in a really understandable way. I'll just give you guys each a quick second to plug anything you're working on, plug your socials. You guys are both great follows. You have a lot of good stuff. So run away with it, Garrett.
So one piece I'm working on, pretty real quick, is looking in much more depth on the role that the state and local tax deduction might look for over the debate next year, particularly that cap on that deduction and what lawmakers may be looking at moving forward. There's going to be a very fractious debate, I think, on that, both in terms of where to put that cap, if a cap will even exist, what to do about business side state and local tax deductions. So we're going to come out with a fresh round of numbers and analysis for folks to hopefully help improve the terms of that debate.
Yeah, and it's no surprise that I'm working on tariff stuff. I've got 3 pieces in the works on tariffs that'll come out in January and February. And of course, I'm on X at Erica D. York, always tweeting or posting about tariffs. So you can catch up on everything there.
And before we sign off, I just want to let you guys know if you have any burning questions on taxes, you can send them our way. You can email us. You can email us at podcast@taxfoundation.org, or you can find us on, I'm still going to call it Twitter. I'm not changing, @deductionpod on Twitter. Thank you guys for listening.